This chapter will introduce you to some concepts of accounting and financial information. Now, accounting and financial information let us analyze the company from obviously a financial standpoint and see how the company is doing. Now, there's two branches of accounting. There's managerial accounting and financial accounting, and the chapter will discuss those in detail, and we'll talk about them a little bit as well. But sometimes you're going to try to decrease your costs and increase your profit as much as possible, but you're also going to be looking at the overall picture. Are you able to pay your bills? What's the long-term prospects of the company surviving? And that's some of the purposes of accounting. As you can see from this slide, the process of accounting is rather broad. It includes actually recording the transaction, but it also includes interpreting those financial results. And accounting sometimes, especially in a public company, is going to be reported to outside parties like stockholders. Even in a private company, your accounting records will be open to your bank or somebody else that you're trying to secure funds from. As I mentioned earlier, there are two broad classifications of accounting, managerial and financial. Managerial accounting is concerned, as this slide shows us, with cost of production, cost of marketing, and making sure that we're following our budget and minimizing our tax liabilities and making sure that we maximize our profits. Financial accounting is concerned usually with the overall big picture of the company, and the financial accountants usually prepare the information for outside investors. Now, one of the other things that a public company will have to do is produce an annual report, or as it's called, a 10K, and that reports all financial information and significant transactions for the year. As a result of ethics and legal violations in companies like Enron and also the recent financial collapse, there have been regulations that actually change how accounting has to be done. And the SOX, or the Sarbanes-Oxley Act, actually requires the CEOs to certify the accuracy of the annual report, or the 10K. And that is something directly from the result of the Enron fiasco. And hopefully at this point you did get a chance to see that movie, the documentary, The Smartest Guys in the Room. Bookkeeping is a little bit different than accounting. Bookkeeping is just simply recording the transactions, and accounting is concerned with interpreting and summarizing those results. The other term that is very important within bookkeeping is double entry. That means that every transaction must have two accounts that it changes. If it credits one account or increases one account, it must decrease another account. So the accounts must balance. And you'll learn a little bit more about that as you take some additional accounting classes as well. The result of accounting are financial statements, and there are three standard financial statements that you will see in the 10K and other places as well. Those are the balance sheet, the income statement, and the statement of cash flows, and we'll discuss those a little bit as we continue here. In any discussion of accounting, we must discuss the fundamental accounting equation, which is the basis for the balance sheet. The balance sheet will list assets, liabilities, and owner's equity. Assets are things of value that the company owns. Liabilities are amounts of money that the company owes, and owner's equity is the difference, the net worth, so to speak, of that particular company. Now, within assets and liabilities, there are current assets, which means assets that can be quickly turned into cash, non-current, those that can't be quickly turned into cash, and liabilities also are current, things that are due right away, and non-current, your long-term, like a real estate loan. We discussed the balance sheet when we were talking about the fundamental accounting equation, but the thing to understand about the balance sheet is that it shows the firm's financial condition at a specific time period, like December 31st of 2014, or at the end of the first quarter. So it's a specific period of time, and it's a snapshot of the company's financial condition, and as I mentioned earlier, it will list assets, liabilities, and owner's equity. The income statement is sometimes called the profit and loss statement, and it will show revenues for a given time period, usually a range, a month, a day, a year. It will then also display the costs, and the difference will be the income, and sometimes it will be a loss. We saw the fundamental accounting equation, which was the basis of the balance sheet, and this is an equation that is the basis of the income statement. So we have revenue minus cost of goods sold. The cost of goods sold, or what it costs you to buy the products that you're selling or produce. That then equates to the gross profit. From the gross profit, we deduct our operating expenses, which would be things like rent and wages and insurance. Then from there, we deduct taxes, and we have net income after taxes. The third financial statement is a statement of cash flows, and you have heard or will hear that cash is king. And the statement of cash flows lets you see where the money that the company needs to operate is coming from, and it can come from operations. That would be profit. It could come from investments. Perhaps it has sold some stock or investing in other things, and it also could be financing. Maybe it's getting a loan, and that's where their money is coming from. But the statement of cash flows is a very, very important statement because it shows you where that operating capital is coming from. Ratio analysis is a way to look at the firm based on the financial statements, income statement primarily, and balance sheet, and see how the company is doing. And there's a few calculations that you'll learn in this text that allow you to analyze different aspects of the company. And if you're thinking about investing, you'll want to do some ratio analysis, and investors will do that before they think about either purchasing the company or purchasing stock within the company. Some of those ratios that you'll learn about in the book are profitability ratios, how profitable is the company, asset utilization, liquidity ratios, debt utilization, and per share data. They're very easy formulas if you have the data, and that's one of the reasons that public companies must report their financial condition every year within that annual report, or the 10K as it's called. Well, this gives you an idea of what to expect within this chapter as you study it. And accounting is very, very important for businesses, whether they be large or small. And invariably, you will take some additional accounting classes as you continue with your business degree.